The key is to get up through today's high, which is like last I saw before we came on, was 34.65. You get up to about 34.95 and close the week there. And that momentum indicator I told you about says you're gone up. Price says you're exploding if you touch 36, triple top breakout. You see those and I think you could almost double silver in a fairly short period of time, probably within 1 quarter. And again, that's not the top. That's not the end of the move. That's just getting up out of this historic silliness. Gold, after all, is well above those levels, right? Made a high at 850 in 1980, made a high at 1920, 2011, and it's 3,500 area. So silver hasn't done that. Now, silver to sort of match that would be up, $60, $70 level. Anyway, that's what I think is about to happen.
Silver is shining brightly to start the week, rallying more than 3% on Monday as the US dollar weakened. The white metal surged above the 10-day simple moving average, signaling renewed bullish interest. The breakout was fueled by a strong move out of an 8-day consolidation pattern, with silver spiking to an intraday high of $34.74. This advance was marked by a wide-range green candle and a breakout above the late March secondary high of $34.59, an encouraging sign for bulls. Market analyst MichaelOliver of Momentum Structural Analysis views silver as nearing a pivotal moment. He points to historical resistance around the $35 level, a price that has been tested repeatedly over the past year. From a technical perspective, this behavior forms what chartists identify as a triple top. However, Oliver argues this isn't a sign of exhaustion, but rather a developing launchpad. A breakout above $35 with strong momentum, he notes, would constitute a triple top breakout and could lead to an explosive rally toward the $60 to $70 range. This view is supported by momentum indicators that have been cooling off over the past year, while prices have remained relatively stable, suggesting the market has been consolidating in preparation for a larger move. Oliver also highlights that gold and silver mining stocks, which have long underperformed since 2020, appear to be on the verge of their technical breakouts. These miners have lagged behind gold during past rallies, but he believes the current setup favors a reversal in that trend. Should breakouts in the miners materialize, they could outpace the performance of the underlying metals in the next leg higher. However, while silver shines, the gold market remains uncertain. The yellow metal has been under pressure amid a firmer US dollar, with gold miners particularly feeling the strain. Major mining companies have posted notable declines, reflecting the sector's sensitivity to gold's price fluctuations. The broader macro picture remains pivotal, but should silver's breakout be sustained and miners confirm their moves higher, the precious metals complex could be entering a new and powerful phase of its bull market. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We made a high. Actually, if you go back and look at a silver chart going back to 1970s, let's say, and you see the peak in 1980 at 50 area, which was, very gaseous type peak. And you were up there so briefly, it was thin air and then it collapsed, okay? And then in 2011, early 2011, before gold made its high, silver got up in just short of 50, like $49 or something, and then dropped and held. This time, when we're up here in the 30s, for the last year, in fact, last May, silver got up to 32.70, okay, dropped, came back up in October, hit 35, they sold it, dropped, came back to 35 again in March this year, and dropped and had that flush where people sold silver thinking, oh, silver's going to go down because the stock market's going down, which is an erroneous assumption. And the people who sold that got killed, because silver popped back over 30 in a heartbeat from 27.5, and now we're pushing toward the 35 again. Getting back to 35 is what point and figure chartists would call, triple top. Now, I use the word top. It really isn't that case. It's a pending quadruple top breakout, or a triple top breakout, excuse me. If you go up to 35 again, I'm going to bet the next tick is 36 and you're gone. That's what the price chartist at that point will start realizing, hey, this action of the last year in silver, which has been violent, but still with a slight upward bias. Go back to last May, it was 32, and earning 34.5, etc. They're going to realize, hey, we made a mistake. This isn't topping. It's been building a launch pad. Now, I don't trust price necessarily, so price says that. The only reason I would agree with myself about that 35 being a pending triple top breakout or a launch pad is that momentum says it is. There's a momentum structure when you plot a momentum oscillator of silver, where you measure silver versus like a 3-quarter moving average or a 40-week average. You'll have a corrective process since last year, since last May. So 12 months of momentum cooling off while price held steady. And there's a structure on it when you look at the momentum chart that says, ooh, if I cross that line, I'm going to blow through. We're challenging that line right now. about another 50 cents above where you are now, you're gone. I think the first leg in silver is highly likely to take out the old dual highs at 50, which again are really phantom historic situations. They don't mean much. They were decades ago. And go probably surge into the mid 60s or 70 zone, somewhere in there, before it even pauses. Now, I don't mean that's the top. I'm talking about this next gush could be a tremendous move, meaning a near double in silver from current levels. The key is to get up through today's high, which is like last I saw before we came on, was 34.65. You get up to about 34.95 and close the week there. And that momentum indicator I told you about says you're gone up. Price says you're exploding if you touch 36, triple top breakout. You see those and I think you could almost double silver in a fairly short period of time, probably within 1 quarter. And again, that's not the top. That's not the end of the move. That's just getting up out of this historic silliness. Gold, after all, is well above those levels, right? Made a high at 850 in 1980, made a high at 1920, 2011, and it's 3,500 area. So silver hasn't done that. Now, silver to sort of match that would be up, $60, $70 level. Anyway, that's what I think is about to happen. Also, the gold and silver miners. My personal emphasis in my own trading is long gold and silver miners, long silver. Watching gold is the mama. But again, I think those two categories, subcategories of gold, we know they've underperformed for the last 3 or 4 years. In that 2020 price surge we had in gold went up to 2,000, silver went up to near 30. And the gold miners, GDX, went up to 45, I think it was. Then gold sort of went sideways for a couple of years, but silver and the miners went into a staircasing decline. So since 2020 through the present, the spread relationship between silver and the gold miners in gold has been underperforming. Technically speaking, they look like they're ripe to turn up. In fact, the gold and silver miners right now are on the edge of breakout. In other words, if you plotted that action, the spread action since 2020, so a fairly long time, there's a structure on the chart you can see, and you're trying to break through it right now. If you do, it'll validate what I'm saying, further validate it, that the place to be is silver and the gold and silver miners. And I think they'll gush a lot more than the upside than will gold. I don't think that we're in a normal bull market. I'm not saying that you've got to go a lot higher than the other ones did. I mean, even if you just matched the prior gold bull markets, which were 8-fold moves from bear low to bull high, you'd be $8,000 gold just to match those peaks. The $850 peak versus its $100 low that preceded it, or the, et cetera, et cetera. But the reality out there, aside from just markets, like political reality, economic stability, monetary notions, institutions that have helped create this crisis, like central banks monopolizing the production of money, that could end. And I think we'll end up in quite probably a gold, silver world again, where it's money, it's legal. It can't be printed overnight at the will of government to pay for this program or that program. By the way, I noticed the other day, Florida, of course, legalized gold and silver as tender, as legal money. They're like the dozenth state to do that in the U.S. Now, when a state government legalizes a new money, gold and silver, in effect, that's saying to the central government, we're seceding from your monopoly control over what we call money. We're allowing gold and silver to compete with your, quote, legal tender. So in a form, that's a form of rebellion, quiet and peaceful, but it's a way to say, hey, we're tired of your money. It's not stable. It's never been stable. It's always been degrading in value. We're allowing the public to use gold and silver as legal money. And even some of the states are allowing you to pay taxes with that. They're setting up agencies to be able to accept gold or silver in payment taxes. So that's the kind of rebellion I'm talking about that occur globally, where there's a transition among the more foresighted countries that we need to get away from this stuff. It hasn't been working. And so I think that means that when you get up there, you just stay up there, because that may be the new priced reality of, you get the point.
In April, silver's price dropped to less than 1% of gold's, a historically rare occurrence that often signals a strong buying opportunity for the white metal. According to MichaelOliver of Momentum Structural Analysis, this kind of divergence typically precedes a phase where silver outperforms gold during a broader bull trend. Historically, when both metals rally, silver tends to rise at a faster pace, amplifying gains as momentum builds. That dynamic began to unfold earlier this year when silver formed a higher swing low at $28.32 in early April. The market responded with a sharp rally, sending prices up to $33.68 in just 11 trading days, a gain of $5.36 or nearly 19%. Now, silver appears to be repeating that bullish behavior. The current breakout emerged from a tight consolidation pattern that mirrors the structure seen before the April surge. This pattern formed around a key support level, previously marked by the top boundary of a larger descending triangle that had developed over the past few months. This triangle had been anchored by support near the 38.2% Fibonacci retracement level, giving the formation a technically significant base. The breakout was triggered on May 21st and has since gained traction. Importantly, the top boundary of the former triangle and the 50-day moving average, both previously acting as resistance, have now been successfully retested as support.
Nominal terms, $8,000 gold versus $1,920 gold. If we went to 8,000, an eightfold move from our bear low, which is 1,050, 2015. You think, well, that's crazy. No, it's not. It's just doing the same thing it's done twice before, eightfold moves. Now, but again, I'm not sure that's going to stop it. I think this bull market, one, is going to possibly go beyond that because of the nature of the government debt crisis. Remember, in the prior bear markets, we had a dot-com bubble, okay? It spin itself, 82% drop in the NASDAQ 100. Took it 16 years to come back to its old high, so it was a wipeout. But it was a market situation. Yes, facilitated by monetary manipulations and so forth over the prior years. It created that bubble. And then we had the other crash, which was the 2007 to 9, but that was mortgages. Now we have government debt, and that's a different monster because the central banks can't just thumb their nose at it. They have to come in. Otherwise, I won't tell you what's going on the streets. You can't have that happen. So the question is, when are they going to push the button, or are they already doing it? Some indications are that they are already intervening in the markets, especially the T-bond market. And when you look at the tonal action of that market over the last specials of the last 6 months or so, when it tries to drop, it suddenly seems to find a floor. It can't get off the floor, but it seems to find one, and it bounces, it keeps coming back down. Right now, again, bonds nearby future, which we treat as a September contract, is 112. Okay. You get down much under 111, like 110 area. It's a couple points, no big deal. It could implode, and that's when you'll have real panic on the part of the central government, meaning monetary excess, like possibly we've never seen. So again, what does that fuel? Gold. It upticked last month and we got down below 1%, meaning if you divide an ounce of silver into an ounce of gold, the April closing level of that spread was like 0.9 something percent, less than 1%. Now, historically, you go back 50 years or so, and the number of times you find that silver prices, 1 ounce of silver is, 1% of the price of gold is very rare. And whenever it does it, it's a buy. I mean, if you go back and you found those times and circle them, somewhere around that time is a major buying opportunity for the net price of silver. Because when that spread goes up, it's always the case that it's silver going up more than gold, not gold going down more than silver, if you get my point. You could have the silver-gold spread favor silver in a bear trend, but it doesn't work that way. It never has. It's always the case that when that silver outperforms gold, it means they're both going up, just silver more. Technically, when we analyze the spread action, not just look at the chart superficially, right now we're back above 1% again. We had a slight up month last month in the close of May, slightly upticked from the, not enough to change the tide. You get back above 1.1%, which is not asking a lot. Wake up, because that indicates that probably it's starting its turn. You ever get above 1.32%, you can write this down if you want. Divide an ounce of silver front month active contract into gold's front month active, and you get it up to 1.32% or higher. I think you could gush to 2% in a heartbeat. Now, what does that say? Well, if you hit those trigger levels, that's basically a doubling in the current price of silver versus gold. So if gold ever went to 8,000, it's normal, eightfold move again, and silver would doubly be $160, 2%. So you get the point. I'm not projecting that as a price. I'm just saying that's the kind of dynamics we're dealing with here. And we're very close to signaling that type of turn, both in the miners versus gold, which I said we're at the structure now, or in fact, we're probably crossing it today, and silver versus gold. And quite often, as you pointed out, it's later in the bull trends that we see that type of behavior where they go berserk more so than gold. And I think we're on the cusp of that. The banks, okay, they're the lenders, okay. We're watching particularly commercial real estate. not home mortgages and stuff. We know that's hurting, and we know it's the high yields are discouraging new home building and so forth, because it's, that's the end of the market that matters. But commercial real estate, there's two ETFs, RWR and VNQ, that cover the commercial real estate holdings. And they both tend to be technically in sync with each other, those two ETFs. They look, first off, they're much heavier than the stock market in terms of what they've done over the recent years. Like when the S&P went up finally and took out its 2022 price high, which was 4,800 level, and went all the way up to 6,100, pulled back to 4,800 recently, by the way, for a bounce, which we expected. If you look at RWR, VNQ, they never even approached the 2022 high. They rallied with the stock market, but they were still well below the high that the market general made in 2022, from which it declined. They declined too, but they never even got back to the 20. So they're very anemic. We understand, and I don't look at the fundamentals, but I hear analysts who know the sector. The debt there is a very big problem with commercial real estate. In fact, about 2 months ago, we had, I think, the largest shopping center in the country or something. It was New York that defaulted on $300 million in debt. Okay, so, it's that kind of thing that could then shin kick the banks. Now, of course, the feds are going to be there, okay? The banks are part of the deal. They're part of the club. So they'll come in, but still, that's an area to watch because it will indicate the internal consequences of high yields. Which these high yields on government bonds are impacting commercial real estate. Debts are due now. I understand a lot of the debts with commercial real estate are due in 2025, 2026, and the yields haven't dropped. And so they're choking. And that could lead to a domino effect. So yeah, I would watch the banks, but again, watch commercial real estate because it's likely to be the domino that hits the banks. And it's an anemic sector.
Silver's recent price movement is signaling a potential turning point in the precious metals landscape. After a period of technical buildup and subdued momentum, the metal appears to be transitioning from consolidation to acceleration. With critical resistance zones being tested and momentum metrics aligning with bullish chart structures, silver could be on the verge of a powerful upward phase. The behavior of mining stocks and technical retests of previously challenging levels is further strengthening the case for a broader breakout. If sustained, this surge may not only elevate silver's value, but also reignite interest in the entire resource sector. Could this be the beginning of a long-awaited resurgence for silver and its miners, or will resistance levels once again stall its ascent? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.